Right, good morning, ladies and gentlemen, and welcome back to Boutiques on Wednesdays. Always great to see so many of you joining us for these sessions online. We've enjoyed super strong returns from SA bonds, and to quote the topic from PortfolioMetrix presentation this morning, is it time to hold them or fold them? Today, we will have an in-depth look at fixed income solutions, and we are joined by Philip Bradford, Chief Investment Officer at PortfolioMetrix, unpacking the factors that are driving our bond market and shed light on return scenarios into the future. We're also joined by Ashvina, Chief Investment Officer at Hollard Investments, to give us a brief update on their business and to look at their income fund as a solution that addresses the paradox of choice in a crowded market with a clear dynamic playbook for income investing. Good morning, Ashvina. Good morning, Philip. How are you doing this morning?
Good morning, Eugene.
Morning, Eugene.
All good.
Fantastic to
Good
have you
morning,
both
everyone.
on this morning. And as I mentioned in my introduction, I think a lot of us had salary returns from fixed income. Yields did come down a little bit. We've seen some strong capital gains, and I think a lot of us wants to know, what is the path going forward? Ashrita, you up first, and you're going to look at a well-rounded solution as well for intermediaries and clients. If you want, you can start sharing your screen. Ashrita,
Thank
I
you.
can see your presentation. Thank you so much.
Thank you, Eugene, and good morning, everyone. Thank you for joining us. In today's session, I'll cover the Hollard BCI Yield Plus Fund, which is a multi-managed fixed income fund that resides in the ASISA short-term interest-bearing category, benchmarked against the average of the category. The fund was launched over 11 years ago, and it is managed by a group of highly experienced fixed income managers. Okay. The fund has had a very interesting journey of discovery, which has crafted its strategy through time, and I'll share some of that insights with you. But before we dive in, a very quick introduction to the Hollard Investments team. We are a diverse team, predominantly female, as you can see, and made up of highly qualified individuals who's had long tenure at Hollard. Hollard is a levered 1B contributor, and we manage a range of 10 CIS funds. Together with the management of the CIS funds, we also offer bespoke solutions to both institutional and retail investors through our implemented portfolio solutions capability. We also manage a big chunk of the Hollard balance sheet investments. So we call these our 3 business propositions, all leveraging off the same research engine and investment process. The philosophy with which we manage money is to compound incremental outperformance over time at a lower risk than the market. And what that means in layman's term is that we aim for small, reliable wins instead of swinging for the fences. And that allows us to produce a more steadier outcome through time. And this philosophy also guides us in how we construct portfolios, how we select managers. Okay, this is our range of CIS funds, and the fund that we're talking about today sits in the income generation category. From a risk perspective, it is 1 notch above a money market and 1 notch below the dynamic income fund, which is a fund that resides in the multi-asset income sector. Okay. This is a snapshot of the characteristics of the fund. So the Hollard BCI Yield Plus Fund aims to achieve a spread over JIBAR of about 1%. Capital protection is key. Hence, no negative quarterly returns is what we set to achieve as well. And the fund has done that since inception. It hasn't had any quarterly negative returns. As per the ASISA guidelines, funds in this short-term interest-bearing sector can have up to a weighted average duration of up to 2 years. And this fund has never got to that level throughout its history, because with duration comes a lot of volatility as well. And the fund is very well diversified. It holds over 200 fixed income instruments. This is a snapshot of our investment process. It has all the standard elements of what an investment process consists of, but our differentiator lies in this market analysis. This is what helps us achieve a good peer relative outcome and outperform the peer average benchmark. And we do that by studying and analyzing the various drivers of returns in the sector. Okay. And those are like, duration management, yield enhancing strategies, credit, whether we should have offshore or not, ILB. So there's a whole range of strategies that you can tap into in this sector. And this pillar allows us to understand those. Okay. This is a picture of the growth of CIS funds over the past 2 decades. And you can see that it's grown significantly and allowing investors like yourselves to have access to more choice. We see a similar trend in the SA interest-bearing short-term sector, where 20 years ago, you had just under 10 funds to pick from, but now you have over 50. With that comes the selection complexity. Which one do you choose? If we look at the benchmarks that managers are using, majority of them uses a STEFI composite in the sector as benchmark. But this chart shows us that outperforming a STEFI composite benchmark is not that difficult, because if you look at this golden line, you can see that majority of funds comfortably outperforms a STEFI composite benchmark. So the true test lies in how are you stacking up relative to competing funds in a universe where choice is so abundant. So for us, a peer average or a peer median benchmark helps us assess how we're stacking up and whether our solution is competitive. Okay. Now, with this abundance of choice and obviously the selection complexity, we want to assess whether the outcome is wide or narrow. If it's narrow, then no worries, you can pick anyone. But when the outcome that you can end up with is wide, then it makes manager selection or fund selection very, very important. So here you can see the dispersion of returns between the best and worst performing funds over time. And you can see that there's an upward trending line, which means that the performance outcome can be quite different. But this also goes to show that managers are employing different strategies in the sector, and choosing the right strategy is quite important. This is what we call a dendrogram. It's one of the tools in our toolbox that we use to understand the universe of managers in a particular ASISA sector. And it also gives us a sense of how managers cluster depending on the strategies that they use. So without going into too much detail on this, if you look at the managers on the left-hand side, those clustering together under the red branch, these are managers that tends to use credit-focused strategies more. So we use a tool like this to decipher what are the various strategies that are available in the sector. So now you have more choice, there's a selection complexity, you want a competitive outcome. How do you make that decision? on which fund to pick. So at Hollard, we are solution creators first and then a multi-manager. So we focus on strategy diversification. We focus on tapping into the multiple risk premias. And our focus is not on combining managers and combining manager brands. In fact, we even give managers strategy descriptors, and with very clear rules of when we ramp up exposure to a particular manager and when we pull back on that exposure, depending on where we are on the market cycle. Okay. And for us to deliver to a peer relative outcome, this is very important, because funds in the sector increases, strategies increases, and through the market analysis pillar of our investment process, we are able to track the diversity of strategies and decide which combination is appropriate for us to combine in order to get a good peer relative outcome. This is a snapshot of the fund's performance through times relative to the average peers. The purple shaded area represent the top 25% of funds, and the bottom golden shaded area is the bottom 25% of funds. And this fund's objective is to achieve a consistent second quartile performance, and it has done that consistently since inception. This is just to show how the rolling 1 year performance looks like. And you can see markets go through cycle, and one has to adapt the strategy to that. Now, it's one thing to have a competitive return, but the quality of the return that gets generated is also very important. So we have a set of metrics that form part of our Vitality tool set, which we use to assess the quality of performance delivered by the fund and the underlying managers. So information ratio, for example, is one which assesses the risk-adjusted return of the fund. And in a conservative sector like the short-term interest bearing, it is an important consideration. So here again, stacking us up against peers, we want a consistent first to second quartile profile, and this is exactly what the fund is delivering. Similarly, batting average is a measure of consistency of outperformance. And here again, we want a first to second quartile as a way of measuring the quality of performance. Again, up capture ratio measures how well the fund captures market upside. And here again, we want to see a first to second quartile profile. Okay. This is our manager research framework. When you assess managers or the fund qualitatively, it's backward looking. It's an assessment of whether the outcome that was delivered aligns to your expectation. But forward looking measure is also very important. So on the right-hand side is a demonstration of our process of how we assess and rate managers. It's one thing to kind of decide and back a manager at a point in time when you invest, but businesses evolve, people change, processes get enhanced, and how such changes impacts your ability to gain the outcome that you had set to achieve is important to continuously assess. And that's what this part of the process does. It's a rigorous semi-annual rating process that we employ here, where we rate how the manager stacks up on each pillar through an in-person meeting with the manager. And each of these pillars are backed by a comprehensive range of questions, which we assess. And we allocate a score to the manager on each pillar. and this culminates into a combined score. The combined score tells us whether this manager or fund still stacks up and is and can remain included in our fund construct, or has risk change such that it needs to be reviewed or put on watch, or we need to redeem our investment. So this is a snapshot of how it looks in practice. So this is manager A, who we've rated, and it's a pretty picture. Risk sometimes comes up, but it's well managed, and this manager has maintained a recommended and highly recommended rating through time. Manager B, for example, was a great manager, but when we included a responsible investment pillar in our rating process, their score retracted, which led to an engagement process with the manager. Manager C stacks up really well. But the picture is not always this beautiful. Sometimes risk become excessive, even though performance doesn't show it. If you look at manager D and manager E, these are examples of managers we have exited or redeemed our investment from, and you can see performance from a backward looking was perfect, but on a forward-looking basis, we think it compromises the ability to deliver. So the process is not complacent at all, and I can tell a story on each of the manager that has undergone this process. Now you might think a multi-manager and the old myth of layering of fees. This is not us. We don't stack ourselves up against the universe of multi-managers. We stack ourselves up against the universe of all managers in the particular sector that our fund resides in. So this box and whisker plot shows the range of fees charged by all managers in the sector, and the top of the purple bar is where we lie. Again, a second quartile fee profile. So the Hollard BCI Yield Plus funds helps you solve for the paradox of choice. It provides you with a competitive and well-diversified solution that has a dynamic portfolio construction playbook and a robust portfolio manager oversight process at very competitive fee. So we're delivering multi-manager value at single manager costs. With that, I thank you all for your attention.
No, thank you very much for that. You can stop sharing. If you can stay on the line, there's a couple of questions for you.
Sure.
Philip, you can start sharing if you're ready.
I hope you can all hear me. Just shout if you can't. But
Perfectly fine. Thanks, Philip.
Great. So as Eugene said in the introduction, we've had a good period of markets, and I've often said that I think a really good professional poker player would make a very good investment manager. And one of the key things with poker players is they need to know when to hold them, know when to fold them, know when to walk away, know when to run, as the song says. But really what it's about is risk management and understanding when the odds are in your favor, and then understanding when they're not. And the last number of years have been an important one, because the perceived risk of bonds, let's say in terms of fixed rate bonds from a volatility perspective in South Africa, have been more than compensating you for any kind of volatility or turbulence you pick up. And actually the real risk has sat more in the credit space, which was the place to be 15, 20 years ago. And what we've seen over the last 12 months, 2 years, even it's coming into the 3-year numbers now, that we've received very good returns from very high starting bond yields. And the good news is they still are quite high today. Importantly, this has happened during a time through South African elections, global conflicts, Trump tariffs, etc. over the last year. But more importantly, over 10 years now that we've been running as a team this portfolio together, we've been through hell. We've been through what's been going on in South Africa and the rest of the world. And importantly, the situation and yields when we started back in 2015 were actually quite a bit lower than they are now, which is a good indicator of forward returns, which I'll tell you just now. So over time, 4% ahead of cash and just over 3% ahead of peers, mainly because we're doing asset allocation in this fixed income space. Now, this is what we call our traffic light or robot slide as a team. And what we're looking at here, there's a lot of information about all the different factors that are influencing South African bonds at the moment. Everything from global interest rates down to specific rand factors. In this column here is the current status. So green means it's in our favor for South African bonds. Orange means amber, obviously, okay, or neutral. And then red obviously means not in a good space. Importantly, though, all these different factors have different weightings. So some things have less importance and others have a lot more importance. So things like global interest rates, SA interest rates, etc., are very, very important, are very important drivers of our bonds and the performance of bonds and the currency in South Africa. These factors do change, though. So these weightings can change, their importance can change depending on different points in time. But importantly as well is the direction, because you can have something like the South African fiscal position in South Africa, in other words, income and expenditure, and it's been weak for quite a long time, as well as growth and investment. But as an example, on the fiscal side, things have been starting to move in the right direction. So when you look at this slide, the most important thing to look at is say, okay, is there more green towards the top? And the more green, if there's more green than red, then we're tending to be in quite a good space. And importantly, the direction is moving in the right direction. So the tide almost has been moving in the favor of South Africa. I could spend an enormous amount of time on each one of these factors, but I thought I would just highlight a few of them. Importantly, we are still in a falling global interest rate environment. And that is very important because at the end of the day, particularly with fixed rate bonds, you're fixing an interest rate at a higher level, or you've got the choice whether you want to fix interest rates or not. We are still in an environment in South Africa where you want to be fixing your interest rates because rates in the world are generally still trending downwards. Importantly, from a South African perspective, as I'll show you just now, our rates are still likely to trend downwards and are driven by what's happening with global rates. In South Africa, we can't be cutting interest rates unless the rest of the world is cutting interest rates. So this adds a lot more, it allows the Reserve Bank just more leeway to cut rates a little bit more into the future. Importantly, what's been happening and has been very fortuitous from a South African perspective is the bounce in precious metal prices here has really helped South Africa, and particularly from a rand, as well as I'll show you just now in terms of trade. Importantly, at the same time when precious metal commodity prices have been going up, oil has been going downwards. And what's been happening with that is as the rand has been moving stronger as well, our precious metals have been going up. It's been helping our exports. So our terms of trade on the right-hand side, on this column going down means positive on the yellow line, is moving in the favor of the rand. So the tide is moving in the favor of the rand. That is positive for inflation. It's positive for revenue collection, terms of trade, etc. So there's this positive side of it. And with oil price being stronger, it's also helping as well, particularly in rand terms, helping with inflation. The next one is this economic reform progress. And this is essentially what's been going on with Operation Vulindlela, which has run out of the presidency. It almost sort of short circuits most of the politicians out the way. But it's similar to our robot slide that I showed earlier. Green means they've done quite well and have completed certain things. So in electricity and freight logistics, as an example. Orange means in progress. Grey, not so good, as blockages, and purple essentially says it's not going well. But overall, we are not in a great place from an economic growth perspective, but the reforms are starting to show some green shoots. And this is very, very important. As a bond investor, you've got to have a 20-year view on these things as well. And importantly, the tide is starting to move in the right direction. And again, the rating agencies, as I'll touch on just now, in particular, are starting to give us a little bit of credit for this. So we've got a lower inflation target. coming our way. And that also gives room for lower interest rates. So the inflation target sends the right signal to markets. Foreign investors are infatuated with real yields. They want to know if your inflation is stable and low, that is a big green tick. And if your yields are high above that, even better. So what we've still got in South Africa is a very high real rate. And by lowering that inflation target, it actually allows us to lower the repo rate more. And the view on inflation is still for inflation to stay around that sort of 3 to 4 range, hopefully trending down closer to the 3% range. And overall, from a foreign investor perspective, that's very positive. Now, what that means is the foreigners are, and they always say the bond market is the smart market, because bond investors are looking into the future. And you can see here effectively the credit rating of South Africa, the way the market prices it, which is almost like your offshore bond yields in a way, are pricing us an upgrade already. So this is your actual credit rating on the green line. The market is already pricing us getting upgraded by the rating agencies. Moody's came out with a relatively positive GDP report this morning. S&P has got us on a positive outlook, and they're going to be giving us an update in December, but potentially a rating increase next year. So the credit rating is trading better than the sovereign credit rating by the rating agencies give us. In other words, the market's pricing better. We're likely to be removed from the grey list on the 24th this month. So let's cross fingers and watch that quite closely, but that's moving in the right direction. And there's a reasonable chance that we could see a rating upgrade early in 2026. And that's a very positive tide behind what's going on in the market. Now, the foreign investors also are the smart investors too, along with the rest of the bond investors. And you can see in the red areas here where foreign investors have started buying our bonds more aggressively again. And particularly in August and September, money's been coming back. We've seen it through bond ETFs, so emerging market bond ETFs have been giving us more money. We've been upgraded in terms of the weighting in those indices, and then the active managers as well have been doing that. And we've been positioning in the dynamic income fund for quite a couple of years now, as yields have been getting high. Particularly this point last year was the highest duration point we ever got to in the portfolio, and that's been paying off nicely. So we've been able to lock in interest rates at nice high levels for investors, immunizing them against falling interest rates. Importantly, bond yields, even though they've dropped down to this level now, are actually not too much lower than they were going into Nenegate in December 2015. And remember, during Nenegate, South Africa was falling off a cliff. We were really going the Zimbabwe route. We were going to get downgraded to junk and fall from investment grade. We're moving back in the right direction. And the yields we're getting now, particularly, this is the All Bond Index. I'll show you just now. The longer dated yields are actually very attractive still at these levels. They're not as attractive as they were a year or two ago, but they still are very high on a real yield basis. And yields of over 9 or over 10% are still giving you 6 or 7% real. Importantly, when you buy bonds, the most important thing is what is the starting interest rate. They like glorified fixed deposits. This is where we were a year ago. Bond yields were around 10%, which gave you a good indication of a forward return of around 10% over the next 2 years. On April the 7th, Liberation Day, just after Liberation Day earlier this year, we added quite a lot of fixed rate exposure and other exposure to the portfolio, locking in nice high yields. The yields have come down to these sort of levels on the All Bond Index, but as I'll show you just now, there are quite attractive yields to be had from here. If we have a look at what are your expected returns going forward from here, bond yields at these sort of levels on the All Bond Index tends to give you around about an 8% average return. The All Share Index at these sort of the price to earnings, or the earnings yield, which is the inverse of that, tends to give you a range of returns around 14%. And when we compare the two together, you can see here the All Bond Index versus the SA equity market. SA equities actually tend to do a bit better from current valuations. Importantly, though, the bonds where we've been focusing on have been some of the longer dated bonds, which make up just under half of the portfolio, which are still likely to give us a low double-digit return into the future from here. Importantly, your other alternatives to bonds as well, cash is a very expensive asset and comes at a very high cost. And I say that simply because cash rates are falling. And if you modeled cash as an income fund in the multi-asset income category, it's pretty much been a fourth quartile fund consistently. This is the rolling 12-month performance of our dynamic income portfolio over the last decade. And you can see that we've almost never been below the peer average, let alone into the bottom quartile. And if you actually look at it over the longer term as well, whether year to date, 1 year, 3 years, 5 years, 10 years, we've pretty much been above the top quintile over most periods of time. But importantly, if you're going to go sit in cash, with cash rates coming down further from here, cash is going to be a fourth quartile asset, and it's going to you can really lock in a yield still today of nearly 4% above cash, like we've got across the portfolio. So over time, you've been far better off in income funds than you have been for quite a long time, particularly in dynamic income over the various other asset classes. And if your lens is just equities, a multi-asset income, and the high equity or the all bond index, there's actually been a better place to be. So there are spots in the bond market, if you know where to look. There are areas of the bond market that are still giving you decent returns. If you're just going to go and buy the all bond index, or just go and buy credit, or just go and buy equities, you're missing out on some of the good opportunities that are out there. And we know that that's worked out for us very, very well over the long period of time now. Even after equities have had a very strong run, there's still been very good returns to be had out of a much, much lower risk asset class like we've seen. So where we are right now, the yield of the fund is still around 10.3. We've actually reduced our duration of the portfolio quite significantly. So almost the only negative thing we can find on the South African fixed income market right now is that it's done very well over the last 12 or 18 months, or even the last couple of years since we've seen an improvement. So everything else is kind of moving in the tide in the favor of the fixed income. We've reduced the exposure simply because yields have come down a bit, but we've still got a healthy kind of exposure. So we've reduced, it's like if you're driving in a car, we've gone from 110 kilometers an hour, we're going at about 90 kilometers an hour at the moment, but 60 kilometers an hour in cash is not going to get you to your destination in time. So 90 kilometers an hour is a nice safe speed. We've reduced that duration, but we've still got a nice high enough yield to give us a nice real yield. Cash will be coming down, so we should be getting close to about 3.5 to 4% above cash into the future still. Importantly, I always show these bull bear scenarios. If everything goes wrong, everyone thinks interest rates are coming down and the world is in a nice space and the precious metal prices are high and the oil price is low and the dollar's weak. If things go wrong from here, we always plan for the worst, and then the good outcomes can come your way if you plan for the worst. A really bad scenario, if interest rates go up from here, if bond yields sell off dramatically, something goes really wrong in South Africa or around the world, we should be generating a return of around about 8%. If things go really wrong, like absolute disaster stuff around the world, in this scenario, equity markets have probably been crashed, particularly in South Africa, and the rand is incredibly weak. In that scenario, you're still sitting around a 6% return, which is just probably slightly below what you're expecting out of cash over the next couple of years. So 10% would be a normal sort of return. A good return would probably be closer to just under 13% on a gross return basis. But importantly, over the next 3 years, given the way we've locked interest rates at these high levels, even with interest rates coming down, we should be able to generate somewhere between a sort of a 9 to 11% return quite comfortably. So despite the markets having run quite hard, I think the easy money, in hindsight, it always seems easy that you needed to lock in interest rates when you could get 12 or 13% just over a year ago and lock in your interest rates at that level. We've been saying that to investors for quite some time, that you needed to do that. But the good news is real yields in South Africa are still very, very high. They're high versus other emerging markets as well. And foreign investors are the ones to watch here. They're the ones who are thinking, hang on, South Africa, you're the cleanest dirty shirt in emerging markets. Your inflation is stable. Your yields are nice and high. And we're starting to allocate a bit more to you. So really, that is my story at this stage, Eugene. And I'm very happy to take some questions around any of that.
Philip, thank you very much for that. I'm going to kick off with a question for you from the audience. And it reads, how are you able to generate higher yields with less duration?
So the key thing about the South African fixed income market to understand that is so different to the other places around the world. Your fixed rate bonds are your longer dated bonds, and they are the best credit quality, most liquid assets in the country by a mile. Okay. The floating rate bonds tend to be mostly your corporate type bonds. And more recently, the government has started issuing floating rate bonds as well. The nice thing about a floating rate bond is it's got no real capital volatility because it's, when you fix an interest rate, that's when you see a bit of capital volatility as well. The game that has changed in South Africa from an investment perspective, from when I started over 25 years ago, the market has changed now where the fixed rate bonds have been giving you the best yields and they are the best credit quality assets. They come with a bit more volatility or turbulence, but they're the ones where you're least likely to lose all your money on them. Okay. Now, the combination of the two of those have been giving you a lower volatility than the all bond index than with a better yield. So we don't have any corporate exposure outside of the banks. So we stick with too big and too important to fail when in South African perspective, when we're looking at credit quality. But the low volatility you get out of a floating rate bond behaves like cash pretty much most of the time, as long as nothing goes wrong from a credit perspective. And then combining that with the longer dated fixed rate bonds has just giving us a much better risk return profile. So still to this day, we can get a yield that's higher than the all bond index, but with much, much, much lower volatility. So on average, we've averaged about half the volatility of the all bond index. But what's important as well is volatility in bonds is very different to volatility in equities. The volatility in the bond market recovers very quickly. So when you, even in the all bond index, which is very volatile at times, it recovers quite quickly because the very nature of a bond, which is a glorified fixed deposit, it matures at a value in the future. So when you do get drawdowns, they tend to recover quite quickly. So what we've been doing is we've been doing asset allocation within this fixed income space. And that allows you then, when bond yields sell off, you're able to take advantage of that because all your floating rate instruments haven't sold off. And then in times like now, when the fixed rate bonds have done nicely, we're able to just reduce some of that exposure and reduce some of the volatility in the portfolio. But I must say that in this fixed income space, if you are going to let volatility drive your lens risk, then you're going to miss out on the best credit quality assets in the country, which are the longer dated fixed rate bonds. Don't let turbulence scare you away. The problem we've got is the credit market in South Africa, because they are floating rate bonds, they behave like cash, and you're taking lots of credit risk, but you're not seeing it in capital volatility. And that is very, very important to understand. So the balance between those two works out very well. And as an example, we don't have any inflation-linked bonds in the portfolio. We found for many years they are overvalued, structurally overvalued relative to the fixed rate bonds. And those bring in a volatility. They're supposedly going to protect you against inflation, but anyone who looks at them over the last 10, 15 years will tell you that it hasn't done that job for you. So really, this fixed income space has become one where you need to understand the turbulence you pick up in fixed rate bonds. You're getting more than compensated for a little bit of turbulence, but like an airplane trip, you get a bit of turbulence on the airplane, but it's still 10,000 times safer than driving to the airport.
Definitely, I do know an intermediary that actually refused to fly, but it's some logic doesn't always make sense. Philip, question from the audience as well, and it speaks to the new inflation target of SA being 3%. Do you think that leaves a lot of room for aggressive cuts or more cuts over the next 2 years, or does that pause that to some extent?
So remember, your Reserve Bank has to keep your interest rates high enough relative to other countries around the world and relative to your inflation. We're one of the few emerging markets that hasn't lowered our inflation target. But what it tells foreign investors, I mentioned it earlier, they want to know that your Reserve Bank is going to put the lid on inflation and stamp it out. What it means in the short term, we probably keep interest rates, the repo rate. Remember, that's the overnight rate. That's not 10-year bond yields. or 20-year bond yield. So when you keep your repo rate a little bit higher, what it tells the foreigners is these guys and girls are going to keep inflation, a lid on inflation, which actually causes the rand to be a bit stronger, which keeps inflation a little bit lower. The Reserve Bank's job is not so much inflation as it is retaining the credibility of your currency. And by keeping interest rates in the short term a little bit higher, actually allows longer term inflation. Remember, inflation means your currency is weakening over a period of time. So this is very, very positive from a bond investor perspective. What it will also allow, it will allow the Treasury not to borrow so much in terms of long-dated bonds. In other words, when they issue debt and they borrow every week a couple of billion more, they'll be able to do it more in floating rate bonds and more shorter duration bonds. That is very positive for longer dated bonds. It's one of the reasons as well where we've got bond exposure, we've got it in the 20-year kind of area. And that is for us, for if you're holding a 1 or 2 year bond, that hasn't been a good, the inflation target hasn't helped you very much. But it's very, very positive if you're holding some of those longer dated bonds like we are in the portfolio.
Ashrina, I didn't forget about you, but I've just got one more question quickly for Philip.
No
Philip, and
problem.
it speaks to the reinvestment rate, and I mean you've presented on that a couple of times as well. In a high yield environment, it's almost free money because your reinvestment yields are so attractive. But let's assume that SARB cuts or puts through 3 or 4 cuts in 2026, yields will come down. How do you then manage new cash flows into the fund having to buy in at lower yields?
Such a good question. That is the one risk that people don't even think about in bonds and fixed income, is your reinvestment risk is incredibly important. So if the yield on your portfolio is 7 or 8%, then you're going to be reinvesting all the interest. Because remember, we get interest coming through bonds, all pay interest at different times, sometimes on the quarterly, sometimes every 6 months. So reinvestment risk is real. Pensioners know this risk. When interest rates come down, they're unhappy. Okay, so that is again one of the reasons why the running yield, like our gross yield of the fund at the moment, I mentioned is 10.3. You know that we are reinvesting around that sort of level. One of the biggest risks to us isn't so much the repo rate coming down, because we can still reinvest at longer dated government bond yields at that sort of level. But if those yields come down quite a lot, it will reduce our ability to reinvest like that. But importantly, if you've fixed your interest rates at those higher levels, then you tend to get a capital gain as it comes down. So absolutely, if you are in a pure floating rate or a money market type fund at the moment, you're at huge exposure to interest rates coming down. How do you, even my mom who's nearly 80 knows this, you want to fix your interest rates when interest rates are coming down.
It almost speaks to one of the questions from the audience as well with regards to retirees. Yes, the fund is suitable for retirees. I can't speak to the percentage. Ashrina, I want to speak to your fund specifically. And just to make it clear, it is a multi-managed solution where you identify the best possible managers given the mandate of the fund. And the 3 managers that you've got in the fund at the moment is Granite, Prescient, and Matrix. Just from a typical multi-manager background, and the answer is maybe that it's probably less relevant in the fixed income space. But given the high allocations to the 3 managers, do you then not have concentration risk?
Thank you, Eugene. That's a very good question. So we have 3 managers, like you mentioned, Granite, Prescient, and Matrix. What I'd like to highlight is Granite does not have a solution in the sector, in the same sector. So it's a mandate that we have crafted individually with Granite to deliver a solution to us in that sector. The mandate with Prescient is not the same as what Prescient, as the fund that Prescient themselves have in that sector. Again, it's a mandate that we've crafted with the manager, with our requirements for what we want from that particular strategy. And Matrix strategy is quite similar because we like Matrix ability to play duration. So in terms of overlap in in the how the managers manage money. This is exactly what we're trying to avoid by picking different strategies. So a Granite, for example, is a very peer-focused managers. They tend to play credit way more than Prescient and Matrix. So should credit spreads widen and you need to pile into credit, Granite is the manager that will do that for us. Prescient is more credit shy, more real return focus, and hence they are almost the risk stabilizer in our portfolio construction. So if things goes pear-shaped, that's the manager that we expect will drive return and create that consistent second quartile performance. Matrix, on the other hand, is a manager that we believe is very dynamic with their hedge fund kind of skill set and background. We believe they are better at playing duration and they don't invest in credit at all. So no overlap from that perspective. And hence why when we combine these strategies, we believe that we don't have much overlap. And that is something that we do look at, instrument overlaps and all of that. But yeah, I think it gives us a very nice, robust combined solution with limited overlaps.
The pricing of fund I find particularly interesting, and I mean you had a slide on that as well. Your TIC sitting at 0.6%, 0.6%, fumbling that. And that's all in, I mean, that's VAT and all fees and underlying fees and administration fees and trading costs and whole shebang. If I look at typical multi-managed income funds, or more specifically fund of funds, the fees tend to trend upwards from 80 to 90 bips plus, some even as high as 1.2, 1.3%. How do you manage to keep the costs so low?
Thank you, Eugene. Another great question. Our belief is that to the end client, it doesn't matter whether you are a single manager or a multi-manager. What matters to the end client is that you can deliver a competitive product and solution at a reasonable price, right? That's what matters to the end client. And that's what we are trying to solve for. So obviously, when it comes to charging fees, we have what we call a high conviction manager selection approach, where we don't create a zoo of managers where you split the assets such that everyone gets a small bag of assets and then that ramps up the fees. We are very deliberate. So hence why you will see that in some of our funds, we very happily sit with two managers or one managers for that matter, because our skill set lies in identifying the most appropriate manager in that sector. And through this high conviction manager selection approach, we can hand a bigger bag of money with the manager and in turn negotiate a better fee. And our approach with managers is not to chop and change. And it's more around creating a long-term partnership with that manager while assessing them at all times, for the robustness of the process that they deliver to us. So that's how we keep the fees low and play to our strength when it comes to manager selection.
And obviously need scalability on the fund in order to do so, which you do have. And I think it does count to the favor in your favor as well. You gave us a very good description of, the different strategies followed by the three managers. Do you from time to time then up or down weight the percentage exposure of the managers to get to a desired outcome given a particular point in a rate cycle?
Absolutely, we do, hey, Eugene. So in that one slide that I showed, we have a strategic allocation to the various managers. So that's what we call our playbook, right? Our playbook is strategically through the cycle, who do we believe has a better edge to outperform? And that's the manager that will get a higher weighting. And then obviously market goes through cycles. There are times when you need to tilt more towards a conservative manager, or there are times that the market environment is such that you need more dynamism in how you manage portfolios, and that guides how we allocate to the different strategies. So our playbook is very clear. We have a strategic allocation, and then we have a low and high. So what's the maximum we can go to this manager, and what's the minimum? And this is how we dynamically play exposures across market cycles.
As we know, you're specifically focused on the Yield Plus fund now, which got a limited duration of 2 years. So it's typically for clients that are a little bit more sensitive to shorter term volatility. I know you also have a dynamic income fund, which is the typical multi-asset income space. So you've got another solution. But looking at this fund specifically, and if you look at the backdrop of SA bonds still offering clients very attractive value, is a limit duration of 2 years not a drawback given where we are now?
That's a very interesting question, and it speaks to a lot of what Philip has said. The yield on this
Yes.
fund is 8.7 at a duration of 0.8. So that's on a real return basis is above 5% real. I mean, it's like wonderful time that we are
Yeah.
living in. And the kind of clients that want this kind of solution is clients that are very sensitive to risk. Hence, balancing that need for extra return with risk or volatility is very important. Hence why capital preservation in this fund is important. Like I said, no negative quarterly returns. No negative quarterly returns is what we are targeting. So yeah, but I think it's a really good real return for the kind of risks that this fund exposes you to.
Absolutely. Philip, there is a question from the audience, but I want to take that question live as well. I know you replied online, but it speaks to locking in high yields. You speak of you need to hold bonds to maturity. What percentage of your bonds do you hold to maturity?
So when you're buying a bond, you've always got the intention of holding it to maturity, and as long as you've got good credit, then that's the most important decision, by the way, when you're investing in a bond. Can they pay me back? And as long as they can do that, then you should have all intention to hold to maturity. However, though, the interest rates in our market change so dramatically. I often show that in the presentations. When we started, if you go back to 2012, I mean, bond yields were 6.5%. Then we were buying bonds at 13.5 a year and a bit ago. So you need to be able to change, mainly in that fixed rate space. But you're always shifting into something that you want to kind of hold to maturity. But more importantly, though, you don't have to wait until the bond matures for the capital to sort of recover, because it's pretty simple. When a bond gets cheap, it's like I always use that analogy of a tight elastic band. It gets cheap, and at some point you're getting your money back in the future. So the capital can only fall so much. So it's very different. If I always compare if you buy a bond from Standard Bank or you buy the shares of Standard Bank, or any company, the shares can stay down for 5 years, 10 years, the share price, but that bond's maturing at a point in time. So eventually it's the elastic band starts coming back. So even though you've got the intention to hold the bonds through to maturity, we have shifted our duration exposure. In other words, we've moved from certain bonds to floating rate bonds or back and forth as the interest rate environment changes. And the good example was the day before the Ukraine invasion 3 years ago. We were at our lowest fixed rate bond exposure ever because bond yields were around 8, cash was 3.5. Hey, a week later, Putin had invaded the Ukraine. We could lock in fixed deposits at 11, and then later 12, and then 13. So you do make those changes, and that's why the dynamic income is important. You need to be dynamic in that space. The world changes, and you need to move around that. But all else equal, though, you're holding low risk instruments at the end of the day, fixed income instruments with a very, very low chance of losing capital over time. And the volatility is just a turbulence around that.
And I
As
mean,
long
you've
as
illustrated that
credit
extremely well. Yeah, you've illustrated that extremely well over time as well. That high activity on switching from floating to fixed rate notes. And it's exactly what investors are looking for somebody to actively manage that. And like you always say, giving bond-like returns, but with less than half the volatility. Can't ask for much more than that. And Ashvina, your fund, if people are not sure who to pick or what to pick, there is a multi-management solution out there, attractively priced. And you've got a whole bunch of other funds in your smarty box as well. Maybe we'll get you some of them in the near future. That's unfortunately all we have time for this morning. It's been extremely insightful. Philip, especially, I think we can replay this to some investors looking for, almost bonds 101. How does these things work? I think you explained it extremely well. Thank you so much for that. To our audience, thank you so much for joining us this morning. Always great to have you with us. Looking forward and seeing you next week, Wednesday, where we have continued discussions with Methodical and New Road Capital. Again, Philip, Ashvina, thank you so much for your time this morning. It's been an absolute pleasure. Thank you.
Thanks,
Thank you,
Eugene.
Eugene.
Thanks,
Thank you,
Ashvina.
everyone. Thanks, Philip.
Thank you.